Hello and welcome once again to CN Professional Institute. We are still on IFRS 13 fair value measurement. Now in this video we are going to solve one question on the highest and best use, and then when we are done we will move on and look at the valuation techniques and then the input to the valuation techniques. Then we'll solve one final question and then we'll draw the curtains on IFRS 13. We'll bring IFRS 13 to an end, right? So let's start and look at question 5. Okay, so let's solve question 5. Question 5 says CNN Limited has just acquired a company which comprises a farming and a mining business. CNN Limited wants advice on how to place a fair value on some of the assets acquired. One of the assets is a piece of land which is currently used for farming. The fair value of the land, if used for farming, is 5 million. If the land is used for farming purposes, a tax credit arises annually, which is based upon the lower of 15% of the fair value of the land, or 500,000 at the current tax rate. The current tax rate in the jurisdiction is 20%. CNN Limited has determined that market participants would consider that the land could have an alternative use for residential purposes. The fair value of the land for residential purposes before the associated cost is thought to be 7.4 million. In order to transform the land from farming to residential use, there would be a legal cost of 200,000 Ghana cedis, a viability analysis cost of 300,000 Ghana cedis, and the cost of demolition of the buildings of 100,000 Ghana cedis. Additionally, permission for residential use has not been formally given by the local authority, and because of this, market participants have indicated that the fair value of the land after the above cost would be discounted by 20% because of the risk if not obtaining the planning permission. In addition, CNN Limited has acquired the brand name associated with the produce from the farm. CNN Limited has decided to discontinue the brand on the assumption that it will gain increased revenue from its own brand. CNN Limited has determined that if it ceases to use a brand, then the indirect benefit will be 20 million Ghana cedis. If it continues to use the brand, then the direct benefit will be 17 million required. Discuss the way in which CNN Limited should measure the fair value of the above assets with reference to the principle of IM together with the principles of IFRS 13 fair value measurement. So this is a nice question. It's a question which talks about the highest and best use, right? Highest and best use of two assets. The assets here are we have what? Um, Land, okay, and what? The brand, which we have it here, right? So we have land and brand, okay. So we want to determine the fair value of these assets. And looking at this, you realize that this is the highest and best use principle because we are looking at non-financial assets, which is what land and then brand. They are non-financial assets, right? So first of all, let's move ahead and determine the fair value of the land first. Then when we are done, we come and determine the fair value of the brand, right? So let's look at fair value of the land. So how do we determine the fair value of the land? We said that they said the current use of the land is for farming, but market participants are saying they can have an alternative use, which is what residential purposes. So we have to look at the value of the land if used for what farming here. Can the land for farming? Okay, the current use is farming, but we are told that it can also be used for what residential purposes. So that's the current use of the land for farming, but market participants are saying it can also be used for residential purposes. You have to determine the fair value or the value if used for farming and the value if used for residential purposes, and then we pick the higher. So the higher becomes what the highest and best use, which is the the fair value. All right. So fair value of the land so we start for what? So for farming, right? So if we use the land for farming, what will be the value? Now we are told that the fair value of the land if used for farming is 5 million. Okay. So it's here 5 million. So let me write my 5 million Ghana cedis here. If the land is for farm purposes, we say we get a tax credit, and a tax credit is a benefit. A tax credit is just like a reduction in your tax payable, okay, or let's say a refund from a tax authority. All right. So tax credit reduces your tax burden, all right, or it reduces your tax liability or your tax payable. So tax credit is a benefit. And if you watch the previous videos, I told you that benefits are added. Any associated benefit is added and associated costs are what deducted. So you have to add a tax credit. Okay. So we are going to add the tax what credit. So let's see how we get a tax credit. They said the tax credit is made up of two things. It is the lower of two things. Lower of 15% of the fair value of the land, or 500,000 at the current tax rate. And we are giving the current tax rate to 20%. So here we have two things. We are going to find 50% of the fair value of the land. And we are also going to find 20% of the 500,000, 20% of the current tax rate. Are you following? 20% at the current tax rate. So we are going to find 15% of the fair value of the land. And we're also going to find 20%, okay, of the 500,000. And then we pick the lower, that's all. He said the credit is what? Based on the lower, is the word here, lower, of 15% of the fair value of the land, or 500,000 at the current tax rate. And they give us we are given the current tax rate, 20%. So find 50% of the fair value of the land, and also find 20% of the 500,000 and pick the lower. That's all. The lower is the tax credit, which will be added to the fair value of the land. So 15%. So this is how we are going to do it. 15% of the fair value of the land. The fair value of the land is 5 million. So 50% of 5 million, what do we get? We get 750,000. Okay. Then also 20% of the 500,000, and this gives us what? 100,000. I following? So if you compare the two, all right, if you compare the two, which one is the lower? I following? The lower is what? The 20% of the 500,000. So the lower is what? 100,000. So that's the credit. So if you come here, we have to come and add what? The 100,000. So that's a tax credit. Okay. So add it to the 5 million, and we get 5,100,000. Right. So this is the value if used for what? Farming. Very simple. Pick the fair value. Yeah, we are told we have what? If it's for farming, we'll get tax credit. So you just have to find the tax credit and add. Tax credit is a benefit. I told it's a benefit. So we have to add. How is it? 15%. We are told that it's the lower of two things. 15% of the fair value of the land, 150% of the 5 million. We got 750. Then also come and find 20% of the 500,000. You get what? 100,000. Pick the lower. The lower of the 750,000 and the 100,000 is what? 100,000. So that's it. Then we go and add. So these are value sheets for farming. Then let's go for residential. So for residential, if you come here, it said the fair value of the land for residential purpose before associated cost is what? So this word is S. Okay. First associated cost is thought to be what? 7.4 million. So fair value, okay, before cost is what? 7,400,000. All right. Then we are going to less all the associated cost. So what are the associated costs? The first one is what? Legal cost. So you can sum all the cost before you less, but you can equally less directly. So me, I'm going to less directly. So 200,000. Then we are going to have, okay, so let me write the names Let me write the names to make the work more presentable. Okay, so our work should be more presentable. So we say we are going to less. Then the first one is legal cost. So that figure is legal cost. So 200,000. Then we have the viability cost. So we have to less the viability. What's the viability cost? 300,000. Then we also have demolition cost. So we have the demolition cost, which is 100,000. So that should also be less, right? Okay, so after lessing the 200,000, the 300,000, and 100,000, if you add this 500, 600, if you less from this, you are going to get 6,800,000. We have 6,800,000. Right now, they said something. They said additionally, permission for residential use has not formally been given by the legal authority, and because of this, market participants have indicated that the fair value after we have deducted all the cost, the above cost will be discounted by what? 20%. So you see, we have deducted the associated cost. We got 6,800,000, and we are told that this 6,800,000 will be discounted by 20%, meaning we have to reduce it by what? 20%. We have to reduce by 20%. Are you following? Now, I told you that the fact that permission is not yet given doesn't mean they cannot get permission. So that's the legally permissible. We looked at that principle. We said we say an asset is not legally permissible if there's a total ban. But if there's no total ban, but they've not yet obtained permission, they can. So it's still permissible. Don't forget that. For this question, the only thing we are doing is that they said there's a risk because they've not gotten the permission yet. They said there's what? A risk. It doesn't mean it's totally banned. They can get it. The use of that land as residential is not banned totally. So they can get it. But they've not gotten it yet. So there's a risk. Okay. That's why they say we should reduce by 20%. All right. If like they say in that area they can't use the land for what? Residential, then all these calculations that we are doing here, we will not do it. We'll just come and use this one for farming. And that will be the current use would have been what? The fair value. So let's discount. Discount by 20% means we have to reduce it. So what you can do, you can just find 80% of the 6,800,000, or you can find the discounted amount. So discount is 20%. Okay. So find 20% of 6,800,000. Okay. And that's giving me 136,000. So 1,360,000. So when we less this one, you get 5,440,000. All right. And this is the value if used for what? Residential purposes or for residential purpose. Or I told you when you get to this side here, when you get to this place here, pick your calculator. Instead of finding the 20% before deducting, find 80% straightforward. Find 80% of this one. You come and get this answer here, right? Okay. So that's it. So now what do? We compare the two. So if used for farming, it's the value is 5,100,000. For residential purposes, it's 5,440,000. So which one is the highest and best use? It's for residential purposes. So we see therefore the highest, I'm abbreviating them, the highest and best use is 5,440,000, which is what? Which is the residential use, right? Is the residential use. Hope you are seeing my handwriting. Which is the residential use. So therefore, the fair value of the land is 5,440,000. Now we are done with the land. Let's go to the brand. We're done with the land. Let's look at the brand. For the brand, they said, okay, the brand that they acquired, okay, in relation to the land. They say, okay, if they decided to discontinue, right? CNN has that word discontinue. Yes, CNN has decided to what discontinue on the assumption that it will gain increased what revenue from its own brands. So CNN is saying, okay, if they discontinue the brand, they will gain increased revenue from their own brand. So if they discontinue what they purchase, the brand they purchase, they will get more revenue from their own brand. CNN Limited determined that if it ceases to use the brand, then the indirect benefit will be what 20 million. If you continue to use, then the direct benefit was 70 million. Now let me explain this thing for you very well so that you get to understand it. Now the rule is that you see CNN when they purchase this brand, okay, they are saying now they want to dispose it or they want to discontinue with it so that they will get benefit from their own brand, and they're saying that the indirect benefit from the indirect benefit they will get if they discontinue to use that brand will be 20 million. If they continue, then the direct benefit will be 70 million. So which one is the highest and best use? You might think, okay, let's compare the 20 and then the 70 and pick the higher. You might think 20 million is the fair value, but it's not 20 million. Why is it not 20 million? Check something. The 20 million arises, okay, indirectly, okay, or the 20 million, okay, arises, okay, or it's an indirect benefit from strengthening CNN's what own brand if they discontinue this brand. So if they discontinue this brand, then it says their own brand will give them what 20 million benefits. You see, that's the indirect benefit. They will gain increased revenue. So meaning that if they discontinue the brand that they purchase, okay, then it will strengthen their own brand. And when their own brand is strengthened, they will get benefit of what 20 million. So the benefit relates to okay the brand that they will be discontinuing. But if they discontinue that brand, it will make them increase, or it will make their own brand what go up, like it will make their own brand increase in value. Okay, now what you have to know is that the 20 million is an entity specific synergy. It means it relates to only CNN. The CNN is saying, okay, if they discontinue the brand, okay, that brand that they purchase, if they discontinue, then they will get indirect benefit from their own brand. I follow. So don't forget that the 20 million is entity specific. It's entity specific. What do we mean by that? It means it is only CNN that will get that benefit. A typical market participant buying this brand will not own CNN what other brand. So the brand that CNN purchase that they want to sell, if they sell that brand, okay, the buyer will not get the indirect benefits that CNN will be getting from their own brand. Okay, so that's what he's saying that if a market participant if a market participant should buy the brand that CNN is selling, that market participant will not own CNN other brand, okay, and will not also get the indirect benefit. The indirect benefit is only available to CNN. Are you following? It's not only available to the market, right? So we are saying that this indirect benefit is only available to CNN. Okay, so if somebody should come and buy the brand that CNN wants to sell, the brand that they bought and that they want to sell, okay, they will get the 70 million benefit if they continue to use the brand that CNN is what selling. But the 20 million indirect benefit that CNN will get is for only CNN. I know the market participants. So what we are saying is that the 20 million, okay, is not transferable to what market participant. It is with only CNN. That's the direct benefit that CNN will get if they discontinue what the brand that they purchase. They will get benefit from their own brand. So the 20 million is available to only CNN, not the entire market. Are you following? And also we said it is not transferable. Okay, it's not available to market participants, and therefore it's entity specific and not the fair value. And don't forget, we said fair value is not entity specific, but it's from the market. So what we are saying is that the 20 million is not the highest and best use. All right. So therefore, if you want to conclude, we say that the fair value, the fair value of the brand is 70 million, not 20 million. The fair value. So we can say therefore the fair value of the brand is 70 million, not the what? The 20 million. That's the reason I'm giving you. The 20 million is what? End specific. It's only CNN that will get that benefit. Okay, but anybody who buys the brand will get the 70 million benefit. Are you following? The direct benefit, everybody will get it. Market participants will get it. But the 20 million is only available to CNN. So this is end specific and therefore cannot be what? The fair value. Therefore, the fair value is what? 17 million, not the 20 million. All right. Let's go and look at the rest and then we close. Right. So let's continue. Valuation techniques. Valuation techniques. All right. So valuation techniques are, let me see, various methods in arriving at fair value, right? So simply we see there are various methods used in arriving at market at the fair value. Okay, the various methods used in arriving at the fair value, and then IFRS 13 has given us three what valuation techniques, right? We have the market approach, we have the cost approach, and the income approach. We have the market approach, we have the cost approach, and the income approach. Now, when we talk of the market approach as a valuation technique, we are referring to we using relevant information and prices on the market to determine the fair value of an asset. So, for example, if you want to determine the fair value of your mobile phone, your land, your building, whatever, you can just go to the market, look at information on the market. Okay, so how much is sold on the market? How much are we going to get from selling this? How much are similar assets sold on that market? Okay, so we just use information on the market. We use prices and information on the market to determine the fair value. That's all. That's the market approach. As the name implies, market. So we use what? You use what? Prices and other relevant information generated by what? Market transactions involving identical, comparable, or similar what? Asset or liabilities to determine the fair value. So with the market approach, very simple. Go to the market, use the prices and information on the market to get the fair value. So this land, this building, if I go to the market, how much will it be sold or how much will it be bought? Okay, or how much are similar assets like this one? How much are they bought or sold? That is the market approach. So simple. The name market uses prices and information on the market to determine the fair value of what? A similar or identical asset. The cost approach looks at the amount that we will incur to replace the service capacity of the asset. We also call it the replacement cost. So we say while the market approach uses price and information on the market, the cost approach uses the cost approach uses the cost that will be incurred to replace the service capacity. Now, this is what it means. This is what the cost approach or the current replacement cost. This is what it means. What it means is that we are looking at the amount that will be needed today to replace the asset capacity, not the same asset. Okay, so for example, let's say if you want to estimate the current replacement cost or the cost approach, if you want to get the current replacement cost of an estate building or whatever, all right, what you do is that ask yourself, okay, how much are we going to incur to buy today? Then you do adjustment for something like depreciation, okay, or maybe economic what obsolescence. You do adjustment for them. So if today it will cost you 50 million to buy the same asset, then ask yourself, okay, we want to get the replacement cost, okay, not the current cost, but the replacement cost. So okay, if it will cost me 20 million today to get the same asset, then if I less the depreciation and whatever, okay, the obsolescence from it, what will it be left? So let's say depreciation is 10 million. If you less the 10 million from it, then the remaining be 40 million, and this 40 million is the replacement cost. Okay, so no, don't miss Don't confuse replacement cost with current cost. Okay, replacement cost is not the same as current cost. Is the current cost on the market. Okay, but the replacement cost goes beyond the current cost. It is the cost after you have taken, or it is the current cost after you have deducted what depreciation and other factors that reduce the value of the asset. So after you have done them like depreciation and what obsolescence, okay, you want to get the capacity, the replacement capacity of it. So that's the cost approach. We are looking at the amount that we are going to get to replace the service capacity to get a similar one today after we have deducted what something like depreciation and what obsolescence. So the only difference between the cost approach, or let me say the current replacement cost, okay, and then the current cost itself is that you pick the current cost and you do adjustment for what things like depreciation or obsolescence, and then you come and get the replacement cost. All right. Then you have the income approach. The income approach, we look at all the benefits that we are going to get from using the asset, and then we discount them to what present value. Okay. So the income approach converts future amounts, okay, to a single current amount or to a single discounted amount. So what we do is that we estimate all the future cash flows that relate to the asset and we discount to present value. So if you should continue to use the asset for like 5 years, year one, year two, year three, year four, how much will you get? Let's say year one, you get 20 million. Year two, you get 30 million. Year three, you get 40 million. All these cash flows, discount them to present value, and that becomes what? The income approach. Very simple. Estimate all the future cash flow that relate to the asset. Okay, the net, that's after taking expenses, the net cash flows, discounting to present value, and that is what you have as your what? Your fair value. And that's the income approach. So income approach uses the present value of all future cash flows that relate to the asset, discounted to present value. Then we have the valuation techniques, which are the assumptions that we use, okay, in pricing the asset. They are data or assumptions that we use when we are determining what the valuation technique. Okay, so the assumptions or the inputs, they aid the valuation what techniques. All right, so the valuation techniques, to get the valuation techniques, we have to do the inputs. So the inputs are assumptions, the assumptions or what data, all right, that market participants use when they want to determine the fair value of the asset or liability. And then these inputs are either observable or what unobservable. So when we talk of observable here, as the name implies, they are observable. So they are inputs that are developed using market data, publicly available information. Okay. So let's say you want to get fair value of your shares. Fair value of shares. The fair value of shares, okay, are listed on the stock exchange. You pick anything like this, their share prices are on the stock exchange. So you see it's publicly available. Publicly what available. Just go there, you see the price. If it's 10 cedis per share, then that's what that's an observable input. The data that we use or the information we have is publicly available, so it's observable. That's why it is what observable what input. Right, so those are what observable inputs. They are inputs that are developed using market data, and therefore we have publicly available information. Whatever we get, we want the information, we can just go to the market and get it. The information is publicly what available. All right, and that is what the observable input. With the unobservable input, for them, they are input for which the market data, okay, are not what available, and therefore we use our own what best our we use best available information, or we use best information what available, all right, about the assumptions that market participants will use when they are pricing their asset or liability. So with the unobservable input, we said information is not readily what available, okay, but we use the best available information. For example, let's say you have your own company, your own firm, or you have your own cash generating unit that you want to fair value. You see, there's no similar, or there's no same CGU, or there's no same company. We can have similar ones. So here what you do is that the information is not publicly available, so you can just use the best available information, which could be a price of similar assets or price of similar liabilities, to come and what value your building or your CGU or your company. All right. So those are what unobservable. Information is not readily what available, and therefore we use our best available information. But as we are trying to look at this best available information, we also look at, or we also consider market participants. Okay, so we have to ask ourselves, will market participants also use that available information? Okay, when they are pricing the when they are determining the fair value. So these are the two inputs. We have the observable input and then unobservable input. Now we have fair value hierarchy. There's something called the fair value hierarchy, okay, which we call the levels, okay, to the input. So the input evaluation techniques, we have levels. We have what? Levels. We have level 1, level 2, level 3. Okay. So the input to the evaluation techniques are placed into what? Levels. Level 1, level 2, level 3. So very important. Let me write them. Level 1, level 2, and level 3. So these are the levels. Now, these are not anything. The standard is saying that, or Ifrs is saying that, okay, if you want to get, or want to determine the fair value, the data and the assumptions you are using, okay, the data and assumptions you are using, use level 1 first. If there's no level 1, where is level 2? If there's no level 2, use level 3. So that's the hierarchy. Very important. You see questions where they try to give you all this. You have to always use level 1. If there's no level 1, then you go to level 2. If there's no level 2, then you go to level what? 3. Are you following? So that's the hierarchy. Now, what are level 1 inputs? We said level 1 inputs are quoted prices and they are observable or unadjusted in active market for identical asset or liability that the entity can access at the measurement date. So with the level 1 input, we said they are inputs, they are assumptions that are readily what? Available. Example again, the market, if you want to get fair value of shares are quoted prices. So you go to stock exchange, the share prices are quoted. They are unadjusted. So you don't adjust them. No. If the share price is 8 cedis per share, then that is what the fair value. It's quoted. You don't adjust it. You don't say, let me add this, let's subtract. No. So they are observable. You can see them there, and we don't adjust them. There's what publicly available information about the event or the transactions. Yes. So if you just type right now, you want to get share of MTN, just type online, just look at it, and then it is there. Go to a stock exchange and it's there. So they are available unadjusted, and they are we don't adjust them. They are public available. We don't adjust them. So if it is quoted 8 cedis per share, then 8 cedis is what? The fair value. That's the level 1. And it says this is regarded as what? Providing the best reliable evidence of fair value. Yes, no adjustment. It's clearly reflected in the market. It's there clearly. So that's why the sign is saying if you want to determine the fair value, go to level 1 input first, because they are more reliable, because there's readily available information. So they are very reliable. So that's level 1 input. Okay, then for level 2, okay, they say level 2 input are input other than quoted prices, including level 1, that are observable for the asset or liability, either directly or indirectly. They include the following. So we say with the level 2, okay, they are quoted. So look at the first one here, quoted prices for similar assets or liabilities in a less active market. So we have the quoted prices for similar assets. So the word is for similar assets. So you pick your land or your building, let's say land. You want to get a fair value of the land, all right? Even if or the land or okay, land or building. Let me add land or building. You want to get the fair value. If you don't get the exact, you might struggle to get the exact land or the exact building, but you can get similar ones. Then you pick the fair value of those similar assets or that similar building or that similar land, and you do adjustment to it. So if let's say somebody has 3 apartments or 3-bedroom apartments, okay, the apartment has 3 bedrooms. Yours also you're having 3 bedrooms, all right. If hers is maybe, or the person's own is, we don't know the person, maybe the person owns 70 million cedis. Maybe you can say, okay, yours is also 3-bedroom, but it has let's say balcony, it has guest room, it has restroom, blah blah blah. So what you do is just pick your this 70 million and do some small adjustment. So you say, okay, because mine has a restroom, it has a guest room and whatever, let me add 3 million to make it what 100 million. You see, I've gotten a similar asset and I've made adjustment to it. Okay, so that's why it says quoted price for similar assets. The second point is the same thing, quoted price for similar assets or liabilities. Here it says what in an active market, and here in a less active market. The bottom line is on what? Similar assets, not the same but similar. So you get the price of similar assets and you come and use it to determine the fair value by doing some small what adjustment with that, because it's not the same. It's a big difference. So you do adjustment. That's level what? 2. Okay. Then level 3, there is no available information at all. There are no similar assets that you can get the fair value. Okay, there are no similar assets that you can charge the fair value of or get the fair value of your asset based on those fair values. So we say level 3 inputs are on what and what observable input for the asset or what liability. Okay, and which when relevant observable input are not available, there's no public available information. The asset whose fair value you want to determine, there's no similar asset. So if there's no similar asset, how do you get the fair value? Are you following? So we use our own assumptions. That's what we are saying. That with level 3, there are unobservable inputs. Okay, there are no readily available information. How do we determine the fair value? Here, this is how we use the cash flow projections. We estimate, okay, all the future cash flows that relate to asset and we discount them to present value. Do you remember the market approach that I explained? We use the cash flow what projections. Look at all the cash flows that relate to the asset and discount it to what present value, and that becomes what your your fair value, because there's no available information. You can't get information on the market. Information about the asset is not quoted. You can also get similar assets that you can get the fair value based on those similar assets. Right? There's nothing available. It's unobservable. So we say if it is unobservable, then we have to use the cash flow projection. We estimate all the future cash flows that relate to the assets, discount them to present value, and that becomes what? A fair value. The standard is saying the fair value hierarchy give priority to what level 1 input and the lowest to what level 3. So as I said, always use level 1. If there's no level 1, they go to level what? You go to level 2. If there's no level 2, then go to level what? 3. This is the hierarchy. Don't forget. You see a question where they give you level 1 input. They tell you the price are quoted, blah, blah, blah. Then they give you level 2. There are no quoted prices, but there are similar assets. That's level 2. Then the level 3, they say, okay, they want to estimate the fair value by discounting all the future cash flow to present value. You should know that's level 3. Let me summarize everything for you. With level 1 input, we said there are available information. There's publicly available data from which we can get the fair value. Example, the share price. It's stated clearly, it's quoted clearly. All right, it's quoted. All right. Then level 2, we said it's quoted prices for similar assets in either the active market or what? Either the active market or the inactive market. So the bottom line is what? Similar assets. So you know they're the same assets, but similar ones. So for example, as I gave the example I gave, you have similar your land that you want to get the fair value, or your building is similar to other ones on the market, and you know the fair value of those ones. Pick the fair value of those ones and adjust them. Okay. If you think yours is better, you add more money. If yours less, it has less features, then you reduce the price. So pick the price on the market and do adjustment. That is what the level 2. With the level 3, there's no available information. There are no similar assets. You have to discount all the future cash flow to present value. All right. So this is the table that summarizes everything here. So example of the level 1 here, quoted prices. Level 2, level 1 is quoted prices on the stock exchange. Level 2 is what? Quoted for similar assets. Example, land held and used. And then quoted interest rate. Then level 3, we use cash flow projections. Example, cash CGUs. Okay, so for the level 3, we said there's no available information. Example is the cash generation unit. So the only way you get fair value is you estimate the future cash flows and discount them to present value. And these are the disclosures. Okay, these are the disclosures. So I'll leave the disclosures to you, scan through them. Let's go through one last question and then we'll bring this one end. All right, question 6. CNPLC has an investment property that is measured at fair value. This property is rented out on short-term leases. The directors wish to fair value the property by estimating the present value of the net cash flows that the property will generate for CNPLC. They argue that this best reflects the way in which the building will generate economic benefit for CNPLC. The building is unique, although there have been many sales of similar buildings in the local area. Required. Discuss whether the valuation techniques suggested by the directors complies with the international financial reporting standards. So you see, if they start reading, things start coming to head or things start coming to mind. It says CMPLC has an investment property. It says the directors wish to what? Fair value the property by estimating the present value of the net cash flows that the property will generate for CMPLC. What level are the directors aiming to use? They are aiming to use level 3. That's it. I told you. With level 3, we use present value of what? The cash flows. So they want to use level 3. But are they right? Instead of saying we can only use level 3 if level 1 is not available and level 2 is also not available. So far as there's level 1, or so far as there are levels 1 and levels 2, you can't use level 3. That's the hierarchy. That's why it is fair value of hierarchy. And I told you how to get each of them. For level 1, there are quoted prices. So there's no adjustment. Level 2, similar assets. And level 3, no available information. Therefore, we use what? Cash flow projections. So here, the they want to use level 3. Let's see. They argue that this best reflects the way in which the building would generate economic benefit for CNPLC. The building is unique, although there have been what? Many sales of similar buildings in the area. You see, there have been sales of similar buildings in the area. What level is that? Level 2. I told you level 2, we don't have the same asset on the market, but we have similar ones, okay, based on which we can do what? Get a fair value. Land is a level 2. I follow, or let me say building is level 2. Building, that's what you have. Building is level 2. You can get similar ones in the area, and based on that, you can fair value. And it's there. They said there are similar ones in the area. So if there are similar ones in the area, that's level 2. So we can just state clearly that the valuation technique suggested by the directors doesn't comply with the IFRS standards. It doesn't comply with IFRS. It doesn't comply with the International Financial Reporting Standards. It doesn't. Why? They want to raise level 3. Meanwhile, there's level 2. There are similar buildings in the area. So they should have used the fair value of those similar buildings and do adjustment rather than using level 3. So don't forget, the hierarchy is very important. If in this question like this, they tell you that there are quoted prices, then you have to go for level 1. It's quoted prices, no adjustment. So this is how let's see how best we can put it. So we can say the directors, okay, they estimated that the future, okay, net cash flows will be used to determine the fair value. So the directors estimated that the future net cash flows will be used to determine what? The fair value. So we can say this is level what? This is level what? 3 input. So if they do that, then they are using what? Level 3 input. Hope you've gotten it. Then we can also say there have been what? Okay, there have been many sales of similar buildings in the area. Okay, there have been sale of many similar what? Buildings in the area. This is level what? This is level 2. All right. Then you come and say IFRS 13. Okay. Says Level 1. Okay, inputs should always be used. Let me say should always be what? Be used. You can say if there's no level, if there is no level 1, then we can use level 2. If there's no level 2, then we use level 3. Okay, now I'll stop writing, you write the rest. Then, so here we can see that. So we started by saying that the directors estimated that they will get the fair value by using the present value, and we said that's level 3. And we also said there are sale of similar buildings in the area, so that's level 2. And IFRS 13 says we should always use level 1 inputs. If there are no level 1 inputs, we use level 2 inputs. If there are no level 2 inputs, we use level 3. Here we can say that from the question, there is what? There's level 2 input available. Okay, so add this. There is what? Level 2 input available. What's that level 2 input? It is the sale of similar buildings in the area. And therefore, the fair value should be based on those similar what? Prices, with adjustments made necessary to reflect a specific location and condition of what? The building. That's all. We said there's level 2 input available, which is the sale of similar buildings in the area. And therefore, we have to use the fair value should be based on those what? It should be based on the prices of those similar what buildings. And then also we have to what? Adjust with adjustment made. We have to do adjustments to reflect what? The specific location and condition of the asset. So that's it. So that's it with this question. This question is testing understanding on what? The inputs. So the evaluation techniques, the levels, level 1, 2, 3. Yes, no, we use level 1 first. If there's no level 1, use level 2. If there's no level 2, use level 3. And level 1 are quoted prices. Level 2, similar quoted price for similar assets. And level 3, there's no quoted price, unobservable. So we use what? Cash flow projection. So we said in this question, there is level 2. There's no level 1 though, because there are no quoted prices exactly. But there's level 2, which is the similar, which is price of similar buildings. Okay, so the directors have to use level 2 instead of going to use level 3, the cash flow projections. So guys, that's it with IFRS 13. Let's end here. We will be solving questions along the line. Okay, we'll be solving questions when should the need be. But here, let's end here. So that's it with IFRS 13. Along the line, I'll be solving questions. So as I said, subscribe to my YouTube channel so that, and then subscribe so that immediately I drop a video, you'll get to you'll be notified. I'll be solving complex questions. That's not the end of IFRS 13, as and when they are necessary. All right. So that's it with IFRS 13 fair value measurement. This is CN Professional Institute. Once again, if you want to be a chartered accountant, if you want to be a professional accountant, if you want to charter in taxation, a chartered tax practitioner, in professional exams, you want to be a chartered economist. Okay, my ACCA people, we are all here. CN Professional Institute is an accredited tuition provider. We train professionals, we train accountants, we train chartered tax practitioners. We train chartered accountants, we train chartered tax practitioners, chartered economists. Okay, so if you want to write any of the professional exams, register with CN Professional Institute. We also have some scholarship packages available which cover your tuition. Right, so you can join CN Professional Institute on scholarship. Just have to contact us, and then if you qualify, you apply and join us. Thank you for watching this video, and I'll see you in the next video.